If your New Year's resolution is to become a better and more well-informed investor, you are in the right place. I'm Liz Thomas, head of investment strategy at SoFi, and this is the important part. Hello, everyone, and happy 2026. We are starting off the year with a bonus episode of the podcast. We're answering some of your most burning questions. Thank you so much to everybody who submitted questions on social media. I have to say, I think this year's set of questions has been the best one yet. There were some real stumpers in there. So we're going to cover all kinds of topics, big things like interest rates, precious metals, technology stocks, and we're going to talk about what the last 3 years of really strong returns might mean for this coming year. Now let's get to it.
This podcast is sponsored by SoFi to help you get your money right. And it's for informational purposes only. Nothing in this program is a recommendation from SoFi. You should not rely on this program for financial, legal, or tax advice or recommendations. The views expressed do not necessarily reflect the institutional views of SoFi or its affiliates.
Okay, so the first big question, and a good one to frame this discussion, was about interest rates. And that was such a huge topic through 2025, and frankly, a huge topic through 2024 and even 2023, but the reasons changed. So the question was, odds of a rate hike in 2026, and then what is your short-term and long-term outlook on rates? Okay, let's start with the probability of a hike in 2026. I would say the probability is quite low. We have inflation that, yes, is still above the Fed's target, but it has cooled substantially. And the main problem with inflation continues to be the housing market, which makes up a big portion of that number. We know that housing affordability is low, meaning house prices are high. So that's what's driving some of that sticky inflation number. Also, we have a labor market that is weakening and has weakened substantially through 2025. So coming into 2026, now I want to be clear, we're not in a bad place with the labor market, but the most recent reading on unemployment was 4.6%, which was higher than what the Fed expected to finish 2025 at. So again, adding fewer jobs than we thought we would be at this point. The average number of jobs added per month has come down. So we're in this sort of balanced spot in the labor market where the Fed does not necessarily see a reason to hike rates. Also, it's important to note the Fed continues to be in a place of loosening monetary policy, definitely not tightening it. And they took an action in December, which was a little bit of a surprise to me included, a little bit of a surprise to everybody, where they started to buy treasuries again at a rate of $40 billion per month. They talked about doing that through April. Now, we would have maybe expected them to start expanding their balance sheet again at some point, but they announced it earlier than everybody thought. So that gives a good indication of where their priorities are in the near term, because that provides more liquidity. It's, again, another indication of loosening monetary policy, not tightening it. Now, the other part of the question, what's my outlook on rates in the short term and in the long term? So if we take the short term as about 1 year, I see rates falling slightly in 2026, but not substantially. And I don't think the market needs rate cuts in order to do well this year. Now, that's in contrast to what I think the market was sending as a message through most of 2025. But again, if the economy is expanding, the Fed is not in tightening mode, I don't think they're really in a strong loosening mode as far as rates go, and I think that's okay. So I don't expect a ton of movement in the policy rate in 2026. Over the longer term, it is so difficult to predict where rates could go. So back to this hiking question, what would have to happen in the longer term in order for them to hike rates? We'd have to see a serious reacceleration in the economy that probably drives inflation higher. We'd have to see much more stability, if not strengthening, in the labor market in order to justify a hike in rates. But I don't see either of those being a real possibility until late 2026 at the earliest, probably more likely 2027 and beyond. All right, next question. This is one that I think everybody has and maybe just doesn't ask out loud. How dangerous is it after the last 3 years of strong returns? And does that 20% Liberation Day pullback count as a reset? So we'll take the first question first. How dangerous is it after the last 3 years of strong returns? So the last 3 years, if you take them all together, produced more than 80% upside in the S&P 500. That is a big, big number. Average annual return on the S&P 500 over a long history is only about 11 or 12%. So 80% in 3 years is a huge number. If you look at times over history when that's happened, so other times where we've had this strong of results, the following 1 year only produced about 5% in the S&P. The following 2-year period only produced about 7% in the S&P. So important thing is to note that both of those numbers are positive, so they're not negative. I think that's really important to keep in mind. The other thing is that it's reasonable, if not probably expected, that we'll see more muted results after such strong results for the last 3 years. That doesn't mean that every single sector or every single stock in the index is going to have that average return. Because the index is so dominated by technology stocks, communication stocks, and even a handful of consumer discretionary stocks, it's possible that some of the big players won't see as great of results as they've seen over the last few years. And then you've got some smaller stocks that could come into the fold. So we do think valuations are frothy, but they're not as high as they were during the dot-com bubble. And that's another thing to remember. The last thing I would say about this is that our mindset in 2026 is to befriend the bubble. And what we're saying is, number one, I can't declare whether or not this is a bubble. I don't know that anybody really can, but we're going to continue to hear that word. So we might as well just get used to it. The idea of befriending the bubble is that when we look at a lot of the indicators that investors have been worried about, we're not seeing loud alarm bells yet that say things are about to burst or that things are about to near their end. So in 2026, it is probably a better bet to befriend some of the upside that we've seen in stocks, including the ones that have won, and get on board with the optimism and the expansion that we've seen in the market. The second part of the question, the 20% drawdown on Liberation Day. As a reminder to everybody, this happened in early April 2025 when there was an announcement from the Trump administration about an increase in tariffs across the board on many, many countries. The market did not react favorably to that and drew down about 20% in a pretty short period of time. Yes, that served as somewhat of a reset. Now, it was seen as self-imposed. It wasn't something that came out of left field and hurt economic growth for an extended period of time. But it's sort of old news now because we're back at new highs in almost all of the indices. So it's not something that has reset the cycle, in my opinion, meaning it hasn't reset the economic cycle, it hasn't reset the market cycle. What it did was shake out some of the excess that existed in the market before that and allowed investors to reset and decide where they wanted to put their dollars afterwards. And we did see a bit of a rotation in stocks, which we'll talk about in another question. Next question is along the same vein of asking about previous performance. We're coming off 4 straight quarters of double-digit earnings growth. How long can that last? And if we get one scare in one of the big tech names, does that change sentiment? You always say consumer sentiment can change quickly. I do say that, and that is important to keep in mind. So let's start with the 4 straight quarters of double-digit earnings growth. It is true we have seen a lot of earnings strength, especially over the last year and especially from technology companies. Earnings growth, in my opinion, can last as long as what we call the spending bender continues to generate revenue. So what I mean by that is a lot of these AI companies have been spending a ton on CapEx, and that spending bender doesn't seem to be slowing down. The rate of growth in spending is coming down a little bit in 2026, but the spending will continue. As long as that spending continues to produce revenue, meaning it's producing earnings growth, it's producing revenue growth for those companies that are engaging in the spending, earnings growth can move forward. In 2026, technology is still expected to be the top producing sector of earnings growth. So we're looking at the companies spending the most, still producing the best earnings growth, and that continues to be the story in 2026. And I think that is important for investors that are looking at things from a fundamental perspective. The risk and the concern, though, I think is valid. And it's a good question to be asking, because if CapEx growth slows, companies stop spending money, it does act as a drag on growth. growth. It acts as a drag on earnings growth, likely, because there's not as much optimism looking forward. It acts as a drag on GDP growth because CapEx does go into the GDP equation for the country. However, so far, we have seen anecdotal productivity gains as a result of this CapEx. So I think that AI CapEx can continue to move forward, and the theme has more runway. Sentiment is a little bit different of a picture. Now, I do talk about consumer sentiment changing on a dime, and that is absolutely true. As soon as consumers get nervous, they change their spending habits, they pull back, they hit pause, they change the stores that they're shopping in. They're very much more careful about the dollars that they're spending and where they're spending them. So sentiment is powerful, and it can prevail even when there's data that says otherwise. A scare in big tech has to be something that, in my opinion, would take a big pillar out of that circular funding diagram. So we heard a lot in 2025 about all of these AI companies engaging in what's called circular funding. So they're sort of sharing revenue with each other, buying each other's products. There's a lot of intertwined revenue and expenses in that entire ecosystem. Some of those companies have basically more in the cards than others do. If one of those big companies, if a scare or something changed in one of those big companies in that circular funding diagram, that's where I think a problem could actually arise. If we have some anecdotal or here and there pops in issues in some of these big tech companies, I don't think that can take all of this down. And frankly, that should be expected as this theme matures. We're not going to see a rising tide lifting all boats forever. So bifurcation is expected. We're expected to see a little bit more of diversification among winners and losers. So I would expect some bumps in the road as we go forward here, but the bigger risk is if one of those big players in the circular funding diagram has a larger scare. The last thing I'll say about this is that consumers and markets have shown remarkable resiliency through this cycle. They've seen through a lot of geopolitical risk. They've seen through market drawdowns, they've seen through volatility, and they've recovered really well on the other side of many things that we thought could take it all down. And I expect that to continue in 2026. I expect to see more resiliency. This is a good time also to mention that if you look at the full outlook that we've published online, you can find it on SoFi.com on the money. You'll find a lot more about each of these topics, and particularly about the sentiment topic. This is something that is really important to dig deep into and get a full answer on. So find our full outlook on SoFi.com. All right, now we're going to jump into some questions that have to do with asset allocation, different sectors. There were a lot of questions about this topic, so I want to make sure that we cover as much as we can. Broadly speaking, the biggest question was, what's your allocation strategy for 2026 and how flexible should investors prepare to be going into the year? Our base case is optimistic. The title of our outlook was "The Show Must Go On," and that's referring to the optimism, the spending, the innovation gains in AI, because that is driving a lot of the sentiment, that is driving a lot of the economic strength, and even the prospect of rotation into other sectors, strength coming from other sectors. So the show must go on, and we are bullish about markets and the economy in 2026. But the environment is heavily reliant on AI optimism. So it's something that, yes, we have concentrated investment in that theme. We also have concentrated reliance on that theme for things to continue. So we're talking about maintaining exposure to big tech, because that is the one that brought us to this dance, and we don't think the dance is over yet. But adding some diversifiers in places like healthcare, materials, and companies that we would consider cash cows. And we'll get into a little bit more about that in a minute. Digging deeper, the next question is, do you believe large growth will be the best performing style or large value? Will rate cuts and rotation make cheap small value the outperformer, or small growth? Okay, so this is really a question about large caps or small caps and value versus growth. Now, growth has been the driver for most of this cycle. Growth generally is things like technology stocks, communication stocks. You can even throw things like biotech and pharma in there. And then value stocks classically have been sectors like financials, industrials, consumer staples. So if we separate the universe that way, that's sort of how it would play out. We do believe that large growth can still produce solid returns. I mentioned earlier that technology is still expected to be the top producer of earnings growth in 2026. But ultimately, I believe value might win this year compared to growth. Both likely to be positive, but I do believe value can do better than growth this year. As the economy broadens out and as strength broadens out into other sectors, investors will continue to look for opportunities outside of some of the names that have run up so much. They already started to do that in 2025. I expect that to continue in 2026. Now, I don't expect rate cuts to be as meaningful this year. I talked about this a little bit earlier. I don't think the market needs rate cuts in order to do well this year. So the question about whether small cap will do well because of rate cuts, I don't think is really the way that we should look at what could drive small cap stocks. Small cap stocks still have room to catch up to large caps because large caps have done far and away better over the last 3 years. So they can still engage in this catch-up trade. However, when the Fed is adjusting monetary policy and it's not a recessionary cycle, large caps have performed better than small caps. So I don't think that this is a time that just because rates have come down, we should look at small caps as the clear possible winner. I think that this is a time where large caps continue to do well, just perhaps in different sectors. Again, some of those sectors that we really like, healthcare, materials, I think financials can do okay this year. Consumer staples even can have a good year. They trailed quite a bit in 2025. And then lastly, as a basket of stocks, looking at something like cash cows. There is actually an ETF that tracks this. The ticker is COWZ. Companies that are cash rich, meaning they have a lot of cash on their balance sheets. They don't have to borrow money or increase leverage in order to finance their own growth. They're fundamentally strong, generally speaking, because of that cash on their balance sheet. They also tend to have lower valuations, so they might fall further into that value camp rather than growth. That is a good place to look in 2026 as well. All right, this next question is actually near and dear to my heart. Asking about precious metals, and thank you for sending a question about precious metals, because I would have been really upset if I didn't get to talk about this on the podcast. Question is, given the incredible run-up in precious metals, if one believes in the US dollar debasement theme, what other investment options should be considered? And to what degree do you feel gold and silver are in bubble territory? All right, first and foremost, gold was one of our calls for 2025. It continues to be one of our calls for 2026. I still believe gold has opportunity, and I still believe it deserves an allocation in portfolios. I am fully aware of its amazing performance. It has actually outperformed the S&P, which is wild, over the last few years, but I still do think that there's appetite for gold out there, and I think there's more upside. So despite that strong performance, some of the reasons for the stability in gold and the gold demand is that institutional and international central banks continue to want to buy gold, and they continue holding gold. They're doing that because we've got geopolitical strife, we've got currency volatility, we've got a post-Russia invading Ukraine world where the dollar was weaponized, and this conversation about dollar debasement started to heat up again. That continues to drive a lot of appetite for gold because countries are protecting their reserves, protecting their wealth in something other than US dollars, and gold has been the option. So in my opinion, that puts a floor on the price of gold. It puts a floor on the demand of gold as well. Now, retail investors have started to get involved in this gold trade, which did make it more volatile, and I do expect there to be fits and starts, so we may see little drawdowns here and there because retail does tend to make things a little bit more fickle, a little bit more volatile. But I still think there's opportunity for gold, so don't run away from it yet. Silver is a different conversation. Now, it gets lumped into precious metals with gold, but it is not the same. Silver has seen an absolutely parabolic move over a very short period of time, even over the last 90 days, so the fourth quarter of 2025. Silver is a much more speculative metal. It does tend to be correlated with gold, but it's not used the same way and it's not purchased the same way by investors. So seeing a chart like the silver chart and watching this parabolic move to the upside, knowing that it's driven in large part by speculation and by some supply squeezes, the chances of the silver price falling, I think, are higher. And the chances of seeing volatility in silver are higher. So I don't think that that particular trade is as sustainable. Another way to play this, if you want a more diversified option, I mentioned before that materials is a sector that we really like going into 2026. Materials is a way to gain exposure to companies that are tied to precious metals, but also diversify out into other things like chemicals, other types of materials like concrete, things that other countries produce. Now, the other thing about materials that's interesting, and I think most people don't know this, I've talked about technology still expected to be the top producer of earnings growth in 2026. In the number 2 spot is materials. So looking at fundamentals, materials actually has a lot of opportunity coming into this year. Last question in this asset allocation sector, sort of what do we do in markets theme is, do you feel in your view that 2026 will see massive corrections in the equity market, or do you see a rebalancing of trades to other sectors? I've already talked a little bit about thinking that the rebalancing and some of this rotation is likely to continue in 2026. So perhaps we see value actually beat growth. So the answer to that, do I see the rebalancing of trades to other sectors, is yes. To be more specific about massive corrections in the equity market, there is always a chance of a crash, a dislocation, some sort of shakeup. Usually those are unforeseen. Usually they are things that are large economic surprises, or maybe there's a geopolitical event. We cannot invest waiting for something like that to happen. So of course that is always a chance. What we have to do is invest with the risks we know. One of the risks that we know in 2026 is that it's a midterm election year in the United States. Midterm election years have tended to be tougher for markets than non-midterm election years. So the average drawdown in a midterm election year is about 19% versus the average drawdown in a non-midterm year of only 12%. I want to make a very important point here. The average drawdown in any year is 12%. So we haven't gotten used to that. We've seen such good results in markets. We haven't gotten used to the fact that intra-year, markets usually see a drawdown of about 12%. But back to the point about midterms, in a midterm year, that average drawdown increases to about 19%. Now, what does that mean? It means that the rotation into other sectors might even be more dramatic, especially during that volatile period, if it should occur. Usually in midterm years, sectors like healthcare do really well and consumer staples. Those are classically defensive sectors. We do like both of those sectors this year, partly because of the midterms coming up. Now, midterm elections usually cause volatility in the second and third quarter. And another thing to point out is that this is not something to be terribly afraid of. Yes, they usually create volatility in markets as we try to figure out with clarity what the next 2 years might look like in Washington. But it's also important to note that the 12 months following a midterm election year have been positive in the S&P since 1938. So the S&P has not seen a drawdown in the 12 months following the midterm elections since 1938. So yes, it might be volatile leading up to it, but afterwards, generally things perk back up as we get more clarity. All right, now we're going to shift outside the US and talk about international a little bit. I got a question about Japan, and I think that this is a really important one to cover. I actually did not talk about this much in the outlook for 2026, so this is sort of a bonus topic. The question is, there are a lot of conspiracy theories going on that with the Bank of Japan raising rates, the Japanese yen carry trade unwinds and markets might follow. My question is, how much of this is realistic? So first, let me explain the question. So the Bank of Japan right now is in a hiking regime. Many other central banks are in cutting regimes. We covered that earlier, talking about the Fed in the US, but many other international central banks are also cutting rates. The Bank of Japan, in contrast, is raising rates because the economy is shifting into a different era and they have started to engage in stimulus. Now, the Japanese economy has been pretty much left for dead for the last 2 decades. So looking at rates in Japan and the 10-year yield, it's been so low for so long. Monetary policy rates have been so low for so long that right now the policy rate sits at 0.75% compared to the US, where the policy rate sits at 3.75%. So it's still very low. But the big important thing here is that Japan has started to raise rates again. Now, what does that mean for the carry trade? During the era where Japanese rates were so low, what it meant was that the Japanese yen was really cheap compared to other currencies. So what investors did was they borrowed in yen in order to invest in other stuff in other currencies. Much of that was done in dollars. So borrowed in a cheaper currency as the yen, invested in a more expensive currency as the dollar. As the Bank of Japan has started hiking rates and as their economy has shifted around, there's been a lot of volatility in the yen. The yen has strengthened at times, it has weakened at times, and through 2025 it actually weakened quite a bit. But there have been scares throughout this process, the most recent of which was in late summer 2024. The yen strengthened a lot, which caused everybody who had borrowed in yen to have to start repaying those loans, and it made their loans more expensive because the yen had gotten stronger. So that's where the carry trade unwind began. And it was a big scare. This was in August, late July, early August of 2024. If you remember, there was a weekend where some economic data came out and then the yen went crazy. US markets went crazy. There was actually, I think, a 20% drawdown in Japanese equity markets and about an 8% drawdown in US equity markets over the course of 2 days. So it was a big event at the time. I say all of that to point out that the carry trade unwind was a very big risk then. Some of it unwound because of what happened then. So it's not as big of a risk now. The bigger risk with Japan is that as the central bank raises rates, what happens is it makes Japanese bonds look more attractive than US bonds. Okay, why does that matter? It matters because Japan has been buying US treasuries for a very long time. Japan is also the largest holder of US treasuries in the foreign market. So as Japanese bonds look more attractive and US treasuries look less attractive because of these interest rates, you are losing basically demand for US treasuries. So what does that mean for US treasuries? It means that yields likely rise, bond prices could come down. It also means that the cost to our government for issuing those treasuries goes up. It also means that anybody who holds those treasuries starts to lose money if this should persist. So I think we should maybe shift our focus away from the unwind of the carry trade, shift it back to the bond market in Japan, the bond market in the US, and I'm talking about long-term bonds, so 10-year plus in Japan and in the US. I think that's where the bigger risk is internationally, and it is definitely something to watch as the year progresses. And then as a bonus, I'm going to take one more question because I really liked this one. If you were going to take a 5% portfolio moonshot, what would it be? So basically, if you were going to put a 5% allocation in something in the portfolio, I wouldn't call this a moonshot necessarily. This isn't like close your eyes and hope for the best. But the 5% allocation, if we have to be really specific about it, I would say biotech. I've talked about healthcare being one of my favorite sectors going into 26. It was actually a favorite sector in 25 as well. It was pretty flat through most of 25 and then perked up at the end of the year. So I got excited and felt like, oh my gosh, we're on the right track. I think in 26, it can do well. Biotech has done really well already. So expect there to be, again, some fits and starts, much like I talked about in gold, because as you see big run-ups, you're likely to see some pauses and retracements before the next leg of a run-up begins. But as the market continues to want opportunities for growth, I think it's going to start looking at other places besides technology and besides the darlings that we've seen bring us to this point. And growth in a healthcare perspective is biotech and pharma, but you can buy ETFs that are specifically for biotech. So that's where I would take my moonshot. I think healthcare can do well in 26 because of that growth appetite and also because of its defensive posture as far as midterm elections. Again, thank you all so much for submitting your questions. I truly believe that this was the best set of questions we've gotten yet. So this was really fun for me. I hope that it was fun for you to listen to. I hope that you learned a lot and got a good glimpse into what our outlook is for 2026. Again, if you want to read the entire outlook, go to SoFi.com/onthemoney, and you'll find places where we dove a lot deeper into some of these topics. So cheers to 2026. Happy New Year to you all. Thank you for watching, and we look forward to bringing you a wonderful year of The Important Part. For more from me, read my weekly column in SoFi's newsletter, On the Money, and on the SoFi website, or follow me on X at Liz Thomas Strat. Follow The Important Part wherever you get your podcasts. The Important Part is produced by SoFi in partnership with Sony Podcasts.
Investments are not FDIC insured, are not bank guaranteed, and may lose value. Elizabeth Thomas is a registered representative of SoFi Securities LLC and an investment advisor representative of SoFi Wealth LLC. SoFi Invest is a trade name used by SoFi Wealth LLC and SoFi Securities LLC, offering investment products and services. Robo-investing and advisory services are provided by SoFi Wealth LLC, an SEC-registered investment advisor. Brokerage and self-directed investing products offered through SoFi Securities LLC, member FINRA SIPC. For disclosures on SoFi Invest platforms, visit sofi.com/legal. For a full listing of the fees associated with SoFi Invest, please view our fee schedule.